Okay, folks. Well, I think we'll get underway here. Thank you so much for joining us this afternoon for this very timely workshop around cash flow management. Before I introduce our speaker today and talk about the workshop, I did just want to acknowledge that even though we are gathered virtually, we are gathered on the traditional homeland of the Tanaha people. I did want to also thank our sponsors for the workshop series that the Fernie Chamber of Commerce puts on, those being our community partners, Island Lake Lodge and the Fernie Fox Hotel. So thank you very much to them for making these possible. Of course, we are in strange times and we can't really do our lunch and learn workshops in person still. You'll note that I'm back in my makeshift basement office here at home. And, you know, as we move through the pandemic and very much into this second wave, cash flow management is really top of mind for all of our businesses, and especially as we head into an uncertain winter ski season and what that may look like. So I think this is a very, very timely workshop. I'm very, very happy to be able to introduce to you all our presenter today, Mr. Gerald Price, who's a CPA and CA with GPI Chartered Professional Accountants here in Fernie. He's been with them for around 20 years and was the winner of in 2018 of the Chamber Legacy Award, the Fernie Business Excellence Awards. He's had a lot to do with our community, very involved with on the accounting side of some of our not-for-profits, and I'm very, very excited to be able to hand over to Gerald, who's going to walk us through cash flow management. And the old saying, you know, cash is king. You know, I think through the pandemic, you know, that's really been the main thing we've all been keeping our eye on, is our cash flow. I mean, we're very used to that in Fernie. The nature of a lot of our businesses is very seasonal. We have very strong periods of revenue, and then it sort of dies off in the shoulder seasons. But COVID-19 has been a real challenge, and so Gerald, I'm very happy to hand the floor over to you. Thank you so much for being here this afternoon.
Thank you, Brad. Let's see if we can get my screen share.
Oh yeah, I will make you. There you go, Gerald. You should be able to move it around now.
Okay. So are you seeing my screen that has a cash flow management, blue and white?
We are, yep.
Wonderful. I've done something right, then I can claim success. I think we've got this set for being about an hour in length with some time at the end for questions. If we have the capacity or capability, if you want to ask questions as we go along, Brad, if I could get you just to pay attention and let me know if there are some questions as we are going through this.
Absolutely.
So I've got the agenda here saying what we're going to be covering off on our cash flow management, why it's important, whether we should be surviving or thriving, how we use cash flow management as a general business tool, different types of cash flow management for different business reasons. We're going to have a discussion of relevant cash flow management strategies as they relate to improving the small business owners' profitability, operating risk, and decreasing the probability of running out of cash, or worse, entering bankruptcy and insolvency. So we've got a few things we're going to cover off that are specific to our COVID situation, where we're going to talk about our Canada Emergency Business Account, or CEBA loan, the CEWS being the Canada Emergency Wage Subsidy, and our most recent addition to the government subsidies, the Canada Emergency Rent Subsidy. We're going to talk about working capital funding, building and equipment funding, bookkeeping and budgeting and forecasting our cash balances, some advanced planning in case of another lockdown, which is starting to look like it's a greater possibility. And just a couple of obvious things to work on as far as improving your cash flow. I'm also going to show you some information as far as some Excel sheets that you can use for cash flow analysis. And then we'll try to cover off any questions that may come from those participants. I'm used to doing presentations live where I get to see the people and see if they have a puzzled expression on their face or not. So in this case, I don't get to see anyone. So you're gonna have to ask questions or chat or just listen, depending on how we want to go about this. So what's important about caring about our cash flow management? I've got a graph here or a picture here showing on the far left-hand side, we're starting off our fiscal year end or our fiscal year with $50 cash. And then we would go to the far right side, we have $30 cash. So it looks like over the year we had a little bit of decrease in our cash. Doesn't look like it would be too terribly bad to handle. But if we take a closer look and say, what happens if instead of having our just opening and closing number, we show what happened throughout the year. And we can see that in June, we suddenly were in the position where if we didn't have credit facilities from the bank, we would be overdrawn and possibly in trouble with some of our suppliers. So it's very important not just to be taking a look at the end and beginning of where our cash balances are, but the transactions throughout the year can really have a major impact on what happens to our business. So ultimately, cash flow, the way we're going to be successful with it is we've got to focus on profit, making our businesses profitable, making sure that for every dollar we have invested, that we're making a return on that investment. Now, ultimately for small business owners, we want to maximize the profits of the business so that we can pay ourselves as much as possible, whether we're doing that in dividends or salaries. And often it's referred to what the free cash flow to the equity holders are. So as we take a look, we can calculate what your free cash flow is. Hopefully all of you are doing some bookkeeping, and quite likely, I'm assuming, on some computer software, the most popular ones being QuickBooks and Sage 50. There certainly are other ones out there that can work. There still are a few people I talk to who are doing their manual ledgers, but certainly I would encourage all of you to make sure that you're doing your bookkeeping on a regular basis, because if you're not keeping track of what's happening on a daily basis or weekly or monthly at a regular interval, you're not going to be able to manage your cash flow. If the simplest form of cash flow management is you're just taking a look at what balances in your bank account, that's a start if you're in a small business, but certainly as you grow, you're going to need to have more information to properly manage your cash flow. So taking a look at what can happen with our cash flow, we have our working capital, which is going to be our current assets less our current liabilities. And if we are in the position where we also have investments in long-term assets, such as our building and equipment, those are longer-term cash investments that we have to make in order to be successful with our business. But ultimately, we want to take a look and say, what can we do with the cash to maximize our ability to pay ourselves, the business owners, as much as we can? This is a chart that shows a lot of the different ratios that can be calculated if you've got the information from your accounting software, so that you can go through and predict whether or not you're going to have a specific problem. This is available. This is called a pyramid analysis. And anyone who wants more information on this type of analysis, if you send an email to me, I can send you the link. And so my email address is Gerald, Gerald, at fernieaccountant.com. And as we take a look at our return on equity, the higher our return on equity is, the more money that is ultimately available for our cash turnover, and therefore the more money that's available for us to pay ourselves. So we want to focus on using as much of the information we can from our bookkeeping software so that we can use that in managing our business cash flows. If you want to have a good business, you have to have good planning, measuring your working capital, taking a look and planning for your expenditures and revenues, and doing a budget, if you can, a year in advance. Also taking a look at what commitments you're going to have as far as buying equipment or committing to buying buildings or other property, making investments. One of our problems that came to light when we announced or were shut down with the COVID-19, we have a real big problem when we don't have any sales, because even though we don't have sales, we still have costs. But the inverse isn't true. It is possible for us to have costs without any sales. And a lot of people found out that if we don't have an emergency fund, we can run out of cash very quickly when we have a surprise event, a black swan, such as this COVID-19 that has come along. Keeping in mind that the more leverage we have on a business, it increases the risk, leverage being borrowed funds, it increases the risk. It can, if we're successful, increase the return that you're making on your money. But when something like COVID comes along, if you've got too much leverage and don't have the ability to generate cash, ultimately the worst case scenario is bankruptcy. So when we take a look and say, how do we want to commit our cash? Do we want to buy a building or do we want to rent a building? There's advantages and disadvantages, and taking a look at what the cash flow requirement is for those two options will often allow the business owner to decide what is actually best for them in their business. So if you own your own building, generally speaking, in good times, you're going to be more profitable, but in bad times, it's far tougher to get out of a responsibility of making a mortgage payment or paying your operating costs than it is when you have a lease. Now, leases certainly are double-edged swords as far as you're committing to stay there for a period of time, but it's often easier to get out of a lease than it is to get out of the building that is dragging you down. So if you take the time to forecast what your needs are going to be to own the building versus leasing the location, you'll have a better understanding of what cash flow you're going to need in order to run your business. We are in the age of data. When I first started accounting back in the early 90s, there were very few businesses that were doing their books, or at least small business, that were doing their books on the computer. Most of them were still doing it in the ledger books. We have so much more data available to us that we can plan so much better. We should focus on using the data that we have so that we can improve our operations. One of our biggest problems is if we're not going to use that information that's available to us from our accounting systems and our software, we certainly run the risk that a competitor will do a better job using their system and data than what we are. So sometimes if you don't or are not utilizing all the data, it might be the difference between dying or surviving in your business. So this course, you might want to take a look and write that down. They have a lot of cash flow management tools at this website. It does make forecasting fairly easy. There is a fee to access the information, but if you're interested, it's well worth the money. This is an example of one of the cash flow statements that you can download from this particular site. This is another example of the ability to forecast what your cash will be on any given month. And as you're starting to invest your money in buying equipment, using up that cash flow, as you follow this dotted line, you can see, depending on where you're at, if you're going to be buying equipment, if you need to finance it, if you've forecasted when you're going to buy the equipment, it will save you a whole bunch of grief. So what you want to do is you want to match your revenues and your related expenses as much as possible. You want to make sure that you have your suppliers, if you can, finance you as long as possible. Of course, your supplier is going to want to be extracting money from you as fast as possible so they don't have cash flow problems. So when we take a look at our operating cycle, we have the days inventory outstanding plus our days sales outstanding minus our days payable outstanding gives us the cash conversion cycle. Our cash conversion cycle is the days that you're paying interest on the money that you don't have. So we want to accelerate getting as much money into your business as soon as possible and slow down the outflows of money so that you can reduce your costs of finance. So one of the problems is if we go into lockdown again, how do you realize money on your inventory? If no one wants to buy anything from you, it's tough to make any money. If people are in the position where they cannot pay the amount they owe you because they're not operating, it can be very difficult. So if we're taking a look and saying, planning ahead, we really need to focus and take a look and say, what could happen? Should I be talking with my suppliers now? Should I be talking with the banker now? And try to get things set up now in case we have another problem in the next few months. When we take a look at longer term operations, taking a look as far as buying buildings and equipment, if you can afford to buy it from your cash flow, that certainly is advantageous. A lot of businesses can buy some of the smaller pieces of equipment from their cash flow. As you get into bigger pieces of equipment, you're going to need to be taking a look and saying, do I want to buy this piece of equipment? Do I want to borrow money? Should I be borrowing money? from the bank? Should I be borrowing the money from a finance company? Should I be leasing it? If you take a look at what your cash flows are going to be from the newly acquired equipment, it can help you decide which direction is better for you to go. So this graph here shows we've got a break-even point right there at the 10,000 units. And what we've got to measure is, as our revenue increases, we're covering off our fixed costs, but we also have variable costs. And so that's how we measure our break-even. If you have an idea where your break-even is, it gives you a better idea of how much money you're going to need each month to continue your cash or to continue operating your business. The best time to be trying to negotiate with your banker to get new lines of credit and credit cards is now. If you wait until you are in the position where you need to have it and you don't have time to get it, it takes time to get the negotiations done with the bank in order to get new credit set up. So if you are at all concerned on what might be happening in the next 6 months, you should be doing a very close look at what your operations are now and focusing on whether you can make arrangements for additional credit now, hopefully before you need it. So when we talk about the CEBA loan, it's a pretty good deal. I'm assuming most of you have hopefully applied for it and been successful in getting it. The big news on the CEBA is that they have announced that they're going to be expanding it to $60,000 from $40,000. The initial $40,000 included a $10,000 grant. The additional $20,000 also includes another $10,000 in grant. It isn't available yet. It's expected to be coming shortly. So the requirement on the CEBA loan in order to receive the $10,000 grant is you've got to pay off that loan prior to December 31st, 2022. And if you pay down $30,000 of the $40,000 in loan, the remaining $10,000 is forgiven. That's a 25% rate of return. And in the meantime, you've got the $40,000 sitting in your account available to cover off any shortfall of cash that you have on an interest-free basis. So if you're unable to repay the loan, come January 1st, 2023, the loan becomes a 3-year term with a 5% interest rate attached to it. It's only interest payments required on the monthly basis, but you have to have the principal paid by December 31, 2025. So ideally, you would want to pay that loan off prior to December 31st, 2022. And just taking a look here, this shows that if you're in the position where you can pay off the $40,000, or I'm sorry, pay the $30,000 off before December 31st, 2022, you get that $10,000 grant. What happens if you can't afford to pull it out of cash flow? This calculation shows that if you could borrow from a financial institution up to 11.11% interest rate is what you could pay, and any rate less than that, you would be further ahead to borrow the money and pay it back than to not pay it back. The government has also been generous with the Canada Emergency Wage Subsidy. The most recent changes came about November 19th, 2020. They've extended our subsidies are available now until June 2021. The maximum subsidy rate for the periods 8 through 10 remains at 65%. The deadline to apply for the CEWS is January 31st, 2021, or 180 days after the claim period, whichever comes later. So certainly we're not going to be applying for our May 2021 CEWS by January 31st, 2021. And that's why we've got the extra 180 days. The eligibility requirement, you've got to have a payroll account on March 15th, 2020. If you purchased the business from someone else, you can still qualify. For periods, or period 1, you had to experience a drop in revenue of at least 15%. Periods 2 through 4, you had to experience a drop of at least 30% in revenue. And period 5 and later, there is not a minimum revenue drop, but the amount of your revenue did drop is used to calculate how big of a subsidy you will receive. Our most recent addition is the Canada Emergency Rent Subsidy, or CERS. I've provided the link to the government website that you can go to. If you just do a Google search of Canada Emergency Rent Subsidy, you should go to the site. The eligibility for getting the rent subsidy, you have to have had a CRA business number on September 27th, 2020, or had a payroll account on March 15th, 2020, or you purchased the business assets from another person who had a payroll account. There are other conditions that may be introduced in the future to loosen this up to additional people as well. You need to determine if you're an eligible business. You are an eligible business if you're an individual or corporation that is subject to Part 1 tax. There are certain entities that, even though they aren't subject to Part 1 tax, they can still qualify, and that list, or those entities are specifically listed. For example, the Chamber of Commerce is not subject to Part 1 tax, but they still are eligible to make a claim under the Canada Emergency Rent Subsidy. You also, in order to be eligible, have to have experienced a drop in your revenue. The periods that you can apply for is the period September 27th to October 24th, October 25th to November 21st, and coming up November 22nd to December 19th. Those are in 4-week increments. The expenses that you can claim, you can't claim amounts that are being paid to a non-arm's length party. So in order to claim, you've got to be paying rent to an arm's length party. The amounts that you are claiming have to relate to the period that you are claiming them in. And the expenses must be paid or payable under a written agreement. And that written agreement had to be in place prior to October 9th, 2020. Revenue for the period of 2020 must be compared to revenue from 2019, and it has to be down. Or you can compare it to what your revenue was in January and February, an average of January and February 2020 to the each of the 4-week periods. You go on to the CRA site to apply for the subsidy, but before you can, you must set up your CERS number. And that is done on the CRA website in your online business account. So those are the funding that is currently available from the government to help us get through this particular situation of the COVID-19. Moving on to more of the working capital funding and what we want to do and how we can operate. So a lot of people like to manage their cash flow through the use of multiple bank accounts. This is a good technique if you are a person who doesn't have quite or or you don't want to, you only want to have the money that's available for you to spend looking or sitting in your operating account. So on that basis, if you're in that situation where you want to be taking a look and saying, I want to make sure that I'm not going to run out of cash, then what you would do is you could set up a bank account that is your regular operating account. And in that account, you're going to collect all of your revenue from sales receipts, and you're going to pay all your operating expenses out of that account. You could set up a second bank account that is your tax account, where the PST, GST, MRDT receipts, any of the money that is collected would initially go into your operating account, and you would then transfer to your second account, your tax account, the balances that were collected, and they sit in that account until it's time to pay them out to the respective levels of government. You can also set up your payroll account as a separate account, and each day you would transfer in the amount of wages that were earned on that day. And then when it comes time to pay the employee, the money is sitting separate, and the net pay as well as the government withholding tax is sitting in that account. And so you can make sure that you can get it paid. So by having multiple accounts earmarked for specific payments, it makes it a little bit easier for you to manage your cash balances and make sure that you're not accidentally overspending. Beyond that, those three accounts, you can also set up an extra bank account that you're going to say is your profit account. A number of finance books have indicated the best thing you can do to make sure that you're getting paid is to pay yourself first. So take a portion of what you expect the profit to be and put it into that bank account, and that can become your emergency slush fund. For seasonal businesses, you might want to start up an account that is where you're going to put your money, that it's available at the beginning of the next season, so that you don't get surprised as far as being short when it comes time to start operations again. Some businesses that require a lot of equipment may want to consider setting up an equipment replacement account. And so all of these accounts you would earmark specifically for items that you want to make sure you have cash funding for, and you would transfer the balances into those accounts on a daily or weekly basis to make sure that the funds are always there when you're going to need them. Another area that the banks or the financial institutions can help us out with is getting a credit card. The wonderful thing about the credit card is you can pay the bills, and if your timing is good, you can take the 30 days that's allowed by your vendor, potentially, make the payment onto the credit card, and the credit card will give you up to another 21 days before you have to pay it. So you're extending that time when you can hang on to the cash longer. You can also take a look at getting a line of credit or an overdraft facility set up so that you can cover off any cash deficits as they occur. Successful businesses use profitable operations as their main source of working capital funding. So if you are operating a business and the profit margins are so thin that you're not making enough money to pay all of your operations, you really need to be taking a strong look and saying, what can I do to either cut my expenses, or how can I improve my profit margin? And if that means you have to increase your price to stay in business, then so be it. Of course, you also have to be cognizant of any of the competitors to make sure that you're not pricing yourself out of the market. So your working capital ratio is calculated by taking your current assets and subtracting your current liabilities. I'm sorry, that gives you your net working capital, the difference between your current assets and current liabilities. Usually in your current assets, you're going to have inventory and accounts receivable being the largest number of your current assets, and accounts payable are often the largest current liability. If your current ratio is low, or your net working capital is low, you are more likely to experience future cash flow problems than if you have a high current ratio with a large positive balance of your net working capital. Now, there's no guarantee on that, because if you've got a lot of inventory or accounts receivable and something happens where people no longer want to buy your inventory, so you cannot convert it to cash, or your accounts receivable become very difficult to collect because the people who bought from you were a poor credit risk, you can still have cash flow problems even if you do have a strong net working capital balance. So you do have to be aware that you need to be able to turn over your accounts receivable on a regular basis and turn over your inventory. The more successful you are in turning over your inventory and receivables quickly, the less likely you are to have a cash flow problem. So sources of working capital funding, if we take a look at how can you accelerate the collection of cash. One way would be to reduce the amount of credit sales that you're willing to undertake, either tighten the rules that you're going to have for your customers to take advantage of credit, give them better ways of making payments to you by accepting additional payment forms such as debit cards, credit cards, e-transfers. You can also consider taking a deposit. If you require deposits for your services, that's a good way of getting cash up front, which will help your working capital. If you have redundant assets or obsolete inventory, selling off those assets rather than paying to store them is a good source of cash. You can source cash by temporarily reducing your balance of inventory, but one thing you've got to be careful of is you don't reduce your inventory to such a low level that you start losing sales. You can also encourage people to pay you faster by offering discounts for early payment. The other way of increasing your working capital is to slow down the outlay of cash. You can do this by paying as much on the credit card as possible, but you have to ensure that you are paying off the balance of that credit card in full each month. If you've got a history of problems with credit card, do not use the credit card. The other way you can slow down the outlay of cash is requesting extended terms from your vendors. Taking a look at financing your building and equipment. How are you going to fund building and equipment? Ideally, if you can fund it from operating profit, that's the best way you can do it. Having said that, we're often in a position where there isn't enough money coming from our operating profit to be able to fund a large single piece of equipment. So what you want to take a look at is when you are buying equipment, try to match the payments that you're going to make or the length of term of the loan that you're going to receive, match it to how long you think that asset is going to be useful for you. So if you're buying a computer that you think is going to last you for 3 years, you wouldn't want to finance that computer for 5 years. It would slow down your or help your cash flow from the point of view of it's extending the amount of term to pay down the cash, but it's also putting you in the position where you've got an asset that after 3 years needs to be replaced and you still owe money on it. So that will have a negative effect on your cash flow once you're past those first 3 years. If you can accelerate the repayment schedule to be a shorter time period than what the expected useful life of the equipment is that you're buying, that will ensure that you're not going to have the surprise of having to replace equipment and still owing cash on the equipment you want to replace. One of the more common areas I encounter this negative equity, as I call it, is on vehicle leases. You'll often have someone go out and lease a truck for their operations, and they will have a cap of 60,000 kilometers on it for a 5-year lease and making $1,000 a month payment on it. They get to the end of the lease, and instead of having 60,000 kilometers on it, they've got 90,000 kilometers on it. So they owe more money, and they then are in the position where they need another vehicle, and the additional loan or the additional payment they owe for going over on the kilometers gets rolled up into another loan, which then they're paying for in the future. So you have that negative equity on your loan on vehicles. It's unfortunately too common to see that. So you want to make sure that you're trying to pay off any of the debt you can, at least as fast as what the asset is useful to you. Also keep in mind when you're acquiring equipment and trying to match your cost of the loan, that as equipment ages, often the cost of repairing it starts to go up. So you may want to be in a position where if you've got something that you expect to last you 6 years, you may want to finance it over 4 years with the expectation that your costs in year 5 and 6 are going to be paying repairs and maintenance on that particular piece of equipment. So other ways of funding your equipment purchases is taking a look at a capital lease or operating lease. And that's just making a monthly payment on it normally. Sometimes you can get them set up to be weekly as well. Capital lease is just one that at the end of the lease, the equipment's going to become yours. And the operating lease is, it gets turned back over to the leaseor rather than going to you. So anytime you're taking a look at controlling your operating leverage, how much money you've got borrowed for your business, you want to evaluate what your fixed costs are and what your variable costs are. As you take a look at those, businesses that have more variable costs can adjust to changes in demand for their product quicker than businesses that have higher fixed costs. Knowing what your fixed and variable costs are can help you adjust your operations when sales volume changes. It's important to remember that when you have sales, you are going to incur expenses. But there again, the reverse is not true. Just because you have expenses doesn't mean you're going to have sales. So you've got to be very careful as far as when you're making your analysis to decide, should I be committing to a fixed expense or should I be trying to get a variable expense? So taking a look at cash flow management, the most important thing you can do with cash flow management is making sure that you are using all the historical information you have from your bookkeeping system so that you can use that information to help forecast what's going to be happening in the future. So make sure you're using your bookkeeping records and making sure that your records are current and that you're reviewing them on a regular basis so that you can identify any trends or potential problems. By maintaining your bookkeeping records as current as possible, you've got more accurate information to use while you're making business decisions. You should be reviewing your balance sheet and income statement at least every month and identify any accounts that might need your attention. As an example, if sales are flat and inventory is increasing month after month, you may need to evaluate the purchase of your inventory as you're tying up more and more money in your inventory. And if it keeps increasing, you may be setting yourself up for having some obsolete inventory in the future. So just by taking a look at a comparison of your accounting records, the current month as compared to the previous month, and also comparing the current month to the previous year's comparable month, will give you an idea of how the changes are happening, and it might give you the warning that you're looking for as far as saying, I need to pay closer attention to this area of my business. Part of the reason, or what we want to do to get cash flow management working for us, is budgeting. Budgets are about planning. When we're putting a budget together, we are expecting that quite likely we will have differences from the actual balances as to what we budgeted. Preparing the budget gives you the opportunity to evaluate your operations and to make changes to improve the operations. Maybe when you're doing your budgeting, you realize that your phone costs are higher than what you think they should be. You can take a closer look to say, what can I do differently to reduce this cost? You want to compare your actual numbers to the budgeted numbers on a regular basis so you can see whether or not what you are attempting to do is working. If you're expecting to have a $100 a month fee for your use of phones and it ends up being $200 a month, you're going to want to be able to examine that and determine whether you're getting the value out of it or whether there's a better plan you can move to. So you want to use the information of your budget compared to actual to improve your operations in your business. Forecasting is going a little bit further than budgeting. And I've got here a link that goes to a free cash flow template. It's actually put out by Microsoft in Excel. You would use this template along with your bookkeeping software to project what you think is going to happen over the next 12 months. By using this forecast, you can then take a look and say, when do you expect to have cash surpluses and cash deficits in each individual month? And do you have sufficient funds if you're going to have a deficit in a particular month? Does the surplus from previous months offset that potential deficit? Because if it doesn't, you're going to have to arrange to have other money injected into the business, either by borrowing from yourself or borrowing from a financial institution. So doing the forecast will help you determine when you expect to have a cash flow problem. You would also want to build into the forecast any of your payments as far as operations, as well as for capital acquisitions and sales. You may be in a position where you expect to buy a truck and you're going to borrow money to buy that truck, but you already have a truck and you expect to sell that. Well, if you do it as a trade-in, you might be fine. But if you decide you're going to buy the new truck and then sell the old truck a month later so that you can get a better deal perhaps in selling it than what you can as far as a trade-in, you're going to have an extra month where you've got to cover additional cash. And so doing the forecast will help you determine whether or not you're going to have a cash flow problem. It's recommended by a number of corporate finance gurus to do a forecast on what's called a rolling 12-month basis. So what you would do there is you would take a spreadsheet, build it to have the 24 columns. You would have your first 12 columns being your actual operations from your accounting software, and put in and show exactly what your cash flows have been for the previous 12 months. You would then forecast the next 12 months using your knowledge of what you expect to be happening in the future, combined with your actual operations. And as each month progresses, you would drop off the oldest actual month and add in the most recent completed month, and your first budgeted or forecasted month would then become your actual month with the correct information from your accounting data or bookkeeping software. And then you would add in the 12th month as far as the forecast 12 months out. There are a number of very powerful templates that are available at a fee, and that was one that I had said, if you want to email me, I can give you the link so you can go in and take a look. It's very powerful as far as being able to do your cash flow, but it does take time and commitment on your part for it to be worthwhile. So advanced planning in case we have another lockdown scenario. What are you going to do if we have to deal with a second lockdown from COVID? If you haven't already done so, contact your financial institution to see if you can arrange additional credit. Try to set up an operating line or an account overdraft. If you have credit already set up, see if you can get those limits increased. If you go into another lockdown, you're going to want to reduce your cash outlays as fast as possible. You're going to want to communicate with your staff and consider a reduction in hours of your staff or layoffs in order to get your wage costs down as low as possible, keeping in mind that you still want to be able to meet your demand for your product. You're going to want to cut any optional payments or defer payments wherever possible. You're going to want to prioritize any future spending for those operational costs that are absolutely necessary. Negotiate with your suppliers, trying to get better terms. Seek discounts from suppliers. If you can afford it, see if they will accept if you pay them immediately, give you a discount to pay faster. Excuse me. Consider whether you have any product on hand that can be returned. Your goal is to make sure that you can survive. You need to survive so that when the lockdown is over, you still have a viable business and you'll be able to get your business up and running again and provide the goods and services. And if you've done a better job than your competitor and you're still around and they're not, you're going to have greater opportunity once the lockdown is over. So we've got to reduce your hours of operations and cut costs as fast as possible so that you don't end up expending some of the cash that you need to have to continue to survive. Try negotiating with your landlord to either extend the payment terms on rent, deferring it to a later time period, and even see if you can get a reduction in your rent. The one downside on that is a lot of the landlords, they too are going to want to be collecting money from you so that they can pay their bills. Consider what changes you can make in entering new markets or change how you serve your existing market. Keep your banker and creditors informed of what you're doing. If the banker is aware that you're having cash flow problems and you're explaining to him what you're doing about it, they're far less likely to come in and give you grief than if it's a surprise that, oh, by the way, I don't have the money to make the payments that are expected to come out. If possible, offer discounts to your existing customers if they give you a significant deposit or prepayment for future goods and services. It can make it a win-win that way as far as they will give you money sooner for product in the future and you've got some cash from them sooner so that it'll help you survive. So some of the obvious ways to improve your cash flow: sell surplus assets. Issue invoices as soon as possible. So if you provided services and materials, get those invoices done out immediately. I'm always surprised by the number of customers that I deal with who are sometimes issuing bills months later or months after they've completed the job. Make it as easy as possible for your customers to pay you as soon as possible. Evaluate your expenses with the intent to reduce any waste. Discount obsolete inventory. Request deposits. Don't go out and buy assets to save on your income tax. When you hear, hey, I bought this because it's tax deductible, that just means that you're saving the tax amount. You're still spending cash. Only buy the assets that are necessary for your business that will improve your operations. Don't work with bad customers. Bad customers will cost you money. That's the end of the slideshow, but I want to show you a couple of these spreadsheets that will allow you to do cash flow forecasting. So this spreadsheet is the one that I showed the link in. It's available for free. It's set up where you can enter the information directly into the financial statement, and it will give you the totals at the bottom, telling you whether or not you're going to have a cash surplus or deficit. And so if you run this on a 12-month basis, it can be enlightening to tell you when you should perhaps be delaying to buy a particular piece of equipment because of the timing of the cash flows. Now, the other one that I want to show you is quite a bit more complex. I'm hoping you guys can actually see this since I'm sharing it on the screen.
Yeah, we can see it, Gerald.
Perfect. Thanks for that confirmation. So this one is built with a lot of formulas in there. We have the blue squares where you would take your actual information from your accounting software and plug it in. A lot of these yellow or light yellow squares, they are calculated. You can put in a formula saying, I expect my revenues to go up by 2% per month, or you could go in and actually override and say, this is what I think my actual revenues will be. You can do that for each one of those light yellow squares. As you're plugging that information in, there's formulas that will calculate based on what your average collection period has been, and it will calculate to give you the idea of what your cash surplus or deficit. You can see it, this row here, that's your monthly change in cash. And we down at this bottom part can enter in these darker yellow or almost orange squares some of our assumptions. Now this spreadsheet is available for a fee, and as I said, it is very useful to help you do cash flow forecasting so that you can identify whether you think you're going to have a cash flow problem. That covers off everything I wanted to go over. Is there any questions that the participants want to ask?
So yeah, guys, go ahead. For those of you who are still with us on the call, feel free to use the chat or the Q&A. While we wait for some questions to come in, Gerald, I just want to thank you so much. That was such a detailed presentation, and there was some really powerful tools in there and a really nice explanation of some of the government support. So thank you so much for your time this afternoon.
You're quite welcome.
You must have answered or explained everything so thoroughly that I don't see a single question between the chat and the Q&A. So I guess you've done a fine job. So thank you.
That or I put them all to sleep. Hopefully
Possibly.
That's not the case. Having said that, I'm going to show you one more thing on my shared screen if I can find it here.
Yeah, absolutely. You bet.
I'm going to go to YouTube here. So this is my favorite Rick Mercer skit. Get ready, it's tax time. Tax evasion is illegal. Just get it over with. You might feel normal again by July. So I have found that quite entertaining over the years when I take a look, and I'm a little bit concerned on where we are with COVID right now with all the government support. I suspect that we are going to see some increased tax rates in the future. I don't know, I don't think it'll happen here in 2021, but by the time 2022 rolls around, I think we're going to be feeling some pain as far as our income taxes go.
Yeah, I think
So
that's a
hopefully that last bit was a little bit entertaining and woke up the participants.
well, it must have. But there is actually a question here from one of our attendees that I'll put to you, Gerald. It's from Ryan, and he asks, he's wondering if there are any government supports for very small businesses, like a bed and breakfast, for example, that doesn't have a payroll but just contracts out their cleaning services.
Boy, the CERB is available. It's the CEBA loan. If you have $40,000 of non-deferrable expenses, you would qualify. But if you're a small bed and breakfast, it is a real challenge to be able to come up with the $40,000 of non-deferrable expenses.
Yeah.
So unfortunately, Ryan, there's not a lot out there if you don't qualify for that CERB payment.
And to answer your second question, Ryan, we have recorded the session this afternoon. So certainly for those who've registered, we can certainly provide that link once I upload it into a Dropbox or something like that. Well, I don't see anything else, Gerald. So again, thank you so much for your time. I really, really appreciate it. We have a few comments here thanking you for your time and saying it was very helpful. So we really, really appreciate it. Obviously, an interesting time. We're all watching what's going to happen. We hope we can avoid any severe business restrictions ongoing, but time will tell. But I think if you followed some of those very helpful tools and advice in that presentation, you'd be well situated as we move into a potential second lockdown. So thank you so much, Gerald. Again, is there anything you'd like to close out with before we wrap it up?
Just a reminder that if anyone wants to have links to some of those two spreadsheets, I can send me the email to gerald@fernieaccountant.com, and I can send you the links so you can take a look at them.
Perfect. All right. Well, thank you so much. And thank you for attending, everyone, and enjoy the rest of your day.
Thank you, Brad.
Thanks, Gerald.